the 𝗥𝗵𝗲 show. Thank you so much for tuning in. And you know what? 80% is showing up. And Ria and I, we always want to give you so much value so that you are constantly improving your life and business. So before I do introduce my amazing co-host, Ria, who's going to be leading the conversation today, and you want to make sure that you got your notepads and pens ready for what about Ria is going to share with us today. But before I bring her on, I want to introduce myself. My name is 𝗥𝗵𝗲, and welcome to the show.
My name is Ria.
And
welcome to our show.
Ria, I'm going to pass the mic to you.
Thank you, 𝗥𝗵𝗲. So to continue on today's topic, there are 7 points about financial IQ that Robert have in the book. And today I'm going to share 4 of the 7 points on financial IQ number 4, which is leveraging our money. 7 points on financial IQ number 4. This is a summary of it. Financial IQ number 4 is leverage our money. Point number 1 is there are many types of leverage, and I'll be discussing each in detail. Point number 2, most investors invest in paper assets they have very little control of. Point number 3, an increase in return does not mean an increase in risk. And point number 4, most financial advisors are not investors. So to go deeper into these points, 4 of the 7 points. So point number 1, there are many types of leverage, and financial leverage, that most people are familiar with is the leverage of debt. The leverage of debt, also known as OPM, other people's money. Second point is there are other types of financial leverage, which include the leverage of our financial intelligence, the leverage of our financial IQ intelligence applied to financial controls. And there are actually 5 of this financial intelligence. And they are increase in income. That is one form of financial intelligence. Second, which is protecting our money from predators. Third form is budgeting. That is a form of financial intelligence. Fourth form of financial intelligence is leverage. And the 5th is information. So these 5 types of financial intelligence, they are forms of leverage. Fourth point, on point number 1 is leverage. What does leverage mean? Leverage is anything that makes your work, my work, your work, my job easy. For example, if we have a crate and we want to move this crate, it is very easy if we have a machine called forklift. So the forklift can easily move this box. So that is a form of leverage. Another example is if we have higher financial IQ, then it is easy to make sophisticated investment decision. So the leverage is having higher financial IQ, which then makes it easy to make sophisticated investment decision. Now let's move on to point number 2, which is most investors invest in paper. These are paper assets, and these are assets that they have little control over. So these are paper assets. So examples of paper assets are as follows. They are our savings. Saving is a form of paper assets. Stocks, bonds, CDs, mutual funds, index funds. So these are examples of paper assets. And like what the book says, paper assets, they are assets that we have little control over. The second point on this point number 2 is because these assets, they allow little to no control, then what happens, the investors, these investors who are investing in paper assets, they have little leverage, they have low returns on their investment. And the book says people who invest in paper assets, they have low financial IQ. So why? This is an example. So an example of low financial IQ is a 5% return on CD. So I just looked today, when you invest your money into CD, which is 14-month CD, right? Because of the high inflation, the interest rate is 4.6%, and the CD is locked in for 14 months. Now, don't forget that when you have the 4.6% interest income, right? That income is being taxed. It's not tax-free, it's being taxed. So this is taxed as an earned or ordinary income. So if your tax bracket is 37%, for example, tax bracket, then that's what your tax bracket, then that is what you're going to be taxed on. Because why? This interest income is an earned or ordinary income. Now, don't forget, we have high inflation. So the high inflation would wipe out the value of our money. How did it wipe out? How did high inflation wipe out our money? Today, right? Today, they say, the government say that the inflation is around 7%. They were able to successfully lower it down from 9% to 7%. Don't forget, this is the reported, okay, reported inflation. Some mentors say it is higher, even higher inflation. They're talking in 2-digit numbers. So let's go with what the government say, that it is a 7% inflation. So 7% inflation in our money earns us, let's say, just to make math easy, 5% interest income. So now 7 minus 5, right? Because the inflation is 7. So we are actually minus 2%. We are negative. Inflation right now will wipe out our value of our money. And look at this. This is what it means that our value for money is wiped out. It's negative too. In fact, we are losing money because the inflation is high. The interest income is only 5%. And don't forget this income that we get, this interest income, we are being taxed on it. This is earned or ordinary tax. So that means this negative 2% is even more negative. This is even more negative because we are paying for the tax. It could be negative 3%, negative 4%, negative 5%, depending on your tax bracket, right? So this is why we're losing our money. Now, point number 3, an increase in risk. An increase in risk does not necessarily mean an increase in return. I mean, it's reverse. An increase in return does not necessarily mean an increase in risk. So, explanation number 1, on this point, when financial advisors say that we have an increase in return, therefore, it means we have an increase in risk. Now, financial advisors are right when they talk about paper assets. Okay, an increase in return means an increase in risk. Why paper asset? Because we have no to little control of it. So that's why we have higher risk. But they are, financial advisors, they are wrong. They are wrong when they speak of all other assets aside from paper, such as business, real estate, just to name a few. Okay, so now another point on this, assets, which I mentioned above, such as business, assets such as real estate. These assets, they require more financial control, which allows for more now these assets, which are the business and real estate, they require more financial, not control, but they require more financial IQ, which allows for more financial control. So what that means is if we have higher financial IQ, we have more financial control over the risk. Now, these assets, the business and the real estate, they permit people to have a higher degree of leverage with very low risk. And the key to this is the third point, the key to this low risk is, you guessed it right, higher financial IQ. Now, fourth salient point is, this is why 𝗏𝗵𝗲 recommends people should start small, should stay small, as we allow our financial IQ to increase. So let me repeat. So 𝗏𝗵𝗲 recommends that people should start small as we allow our financial IQ to increase, so that when our financial IQ increases, then we have very low risk. Fifth point, with increase in financial IQ, our returns on our investment goes up. Sixth point, if our financial IQ is low, then the leverage, or the leverage we have, may deliver a black eye, deliver a blow to our financial IQ, which is measured by the returns on our investments. Point number 4, and this is, most financial advisors, they are not investors according to the book. Why? So financial advisors are salespeople. And most of them, they invest only in paper assets. paper assets. Now, paper assets are again are savings. Oops. They are savings, CD, stocks, bonds, mutual funds, index funds. So most financial advisors only invest in paper assets. I said most, not all. So therefore, in many cases, and financial leverage ratio is 1:1. So what does that mean? 1:1 professional ratio means that they are being paid, or they get paid for their work, and only their work. So a day's pay for a day's work. So they're trading their time, right? Time for money. Fourth point, as a business owner, Robert has thousands of people working to assist him. So an example is his investment on the 300 apartment units. So with the 300 apartment units, Robert has 300 tenants that help pay for his investment. And then, because it's a business, the bank lends Robert $4 for every $1 of his money. Now, as a business, Robert, what the government does, the government, specifically the tax department, gives Robert tax breaks on his income. So Robert, because of the tax break, pay less in taxes. So these are examples of different types of leverage. 4 of the 7 points today on financial IQ number 4, which is leveraging our money. Point number 1, these are summaries. Point number 1 is there are many types of leverage. Point number 2, most investors invest in paper assets. These are assets that we have very little control of. Point number 3, an increase in return does not mean an increase in risk. Point number 4, most financial advisors, they are not investors. So to go deeper on point number 1, which is there are many types of leverage. So financial leverage most people are familiar with is the leverage of debt. The leverage of debt, also known as OPM, or other people's money. Second, there are other types of financial leverage, which include the leverage of financial intelligence applied to financial control. This is a keyword, control. There are 5 forms or types of financial intelligence. These are increase in income, that is, and financial intelligence. Protecting our money from predators is another form of financial intelligence. Budgeting our money, leveraging our money, and information about money. So these are financial intelligence. 4th point, leverage. What is leverage? Leverage is anything that makes your work, my job, easy, a little bit easy. An example, if we have a box that we need to move, it is very easy to move this when we have a machine called forklift to lift this up. That is an example of leverage. Having higher financial IQ, it is easy to make sophisticated investment decisions. So the leverage is having a higher financial IQ. When we have higher financial IQ, then it is easy for us to make sophisticated investment decisions. Point number 2, most investors invest in paper assets, assets that they have little control over. First point, examples of paper assets are savings, stocks, bonds, CD, mutual funds, index funds. Second point, because these assets allow little to no control, these investors have little leverage, have low returns on investment, have low financial IQ. Why does Robert Kiyosaki say it's low financial IQ? So he gave an example. Let's say, if we put our money on a CD today, at today's rate, you could earn 5%. Specifically, it's 4.6% for a 14-month CD. You lock it in, you cannot get it out. Otherwise, you get penalized. So 14 months, you get 4.6. You may say, hey, Ria, that's really high compared to last year, which was only earning 1% last year. So let's take a look why this is low financial IQ. If you put your money into a CD that gives you a 5% interest. Now, don't forget, when we earn money from the bank, it's called interest income. Okay, so that means our interest income is being taxed. It's not tax-free. We are being taxed on it, on earned or ordinary income. So if your tax bracket is 37%, that is how much you pay on the interest income. Now, we are on high inflation today, and having high inflation will wipe out the value of our money. So, to dig further, today, the government reports that they were able to successfully reduce the reported inflation from 9% to 7%. It went down by 2 points. And how did they do that? They increase our interest, the borrowing money. They increase our interest when we borrow money, right? So that's how they lowered our inflation from 9 to 7%. So according to them, they lowered it by 2 points. That is the reported inflation. Now, if you listen to billionaires, they say the inflation is even in 2-digit numbers. It's higher than the reported inflation. So just say, for this example, it's 7%. To make math simple, it's 7% inflation. And we earn on our CD an interest income of 5%. Okay, that's locked in for 1 year and 2 months. So 7, which is the inflation, minus 5%, we are now negative 2%. Okay, we are -2, and that's why the books say if we have low financial IQ if we put our money into paper assets because it only gives us 5% return. Now, don't forget, this is not considering the tax. This -2 is only being subtracted by the inflation. Now, because it's an earned income, we earned money, we got interest from our money, we are being taxed on it. It's called earned or ordinary tax. So this -2 means it's even more negative. It could be -3, -4, -5, depending on our own particular tax bracket. And that is why he said putting our money into paper assets, we have low financial IQ. And this is exactly why. Point number 3, an increase in return does not mean an increase in risk. 1, when financial advisors say an increase in your return means an increase in risk, Robert says they are correct. Financial advisors are correct only when they speak of paper assets. Paper assets have high return when you have higher risk. Why? Because you have no or little control. Now, these financial advisors are wrong when they speak of all other assets. For example, the business and the real estate. Second point, assets like business and real estate, they require more financial IQ, which allows more financial control. So when we have higher financial IQ, we have more financial control. Okay, this is what the equation means. Increase our financial IQ, we have more financial control. So we permit a higher degree of leverage with very low risk. Now, the key to having low risk, okay, the key to having low risk is higher financial IQ. Don't forget, having a higher financial IQ is another form of leverage. It's a form of leverage. Having higher IQ, this is the key to everything, higher financial IQ. Fourth point, this is why Robert recommends that people should start small. Stay small as we allow our financial IQ to increase. We need to allow our financial IQ to increase. When we have high financial IQ, that means we have very low risk. Fifth point, with increase in financial IQ, our returns on investments would also go up. 6th point, if financial IQ is low, then leverage may deliver a blow to financial IQ. The financial IQ is measured on return on investments. So if financial IQ is low, then we'll have an interest rate of 5% interest on our CD. So that means it's going to have a return that is low or even negative in the example I provided earlier. Point number 4, most financial advisors are not investors. Financial advisors are salespeople, and most of them invest only in paper assets. Paper assets, again, are savings, CD, stocks, bonds, mutual funds, and index funds. In many cases, their professional and financial leverage ratio are 1:1. So what does 1:1 professional ratio means? They get paid for their work and only their work. A day's pay for a day's work. So they're trading their time for money. 4th point, as a business owner, Robert has thousands, okay? That's not 1,000, thousands of people working for him to assist him. So an example of this is his 300 apartment units. That means Robert has 300 tenants helping him pay for his investment. Not only that, the bank lends Robert $4 for every $1. So if Robert has 20,000, the bank would give him 100,000 of money, right? So this is Robert and this is the bank. This is a form of leverage. This is OPM. So this is what it means. The bank will give you $4 when you have $1. Now, Robert also has, so this could be 80 to 100,000 leverage. Now the government, don't forget the government, the tax department gives Robert tax break on his income. Why? Because the government, Robert is doing what the government wants him to do. He's being incentivized to provide housing, to solve the housing needs of the community. So Robert pays less in taxes. So these are the example of different types of leverage. So stay tuned for more. I will be discussing point 5 to point 7 on the next show. 𝗥𝗵𝗲 show.
Thank you. And guys, I hope you had a pad and paper, notepad and pens, because, Ria shared just amazing nuggets right there. Ria, that was just so amazing. I just want to touch on point number 4. You talked about financial advisors are not investors, and yet absolutely 100%. But what people don't know or may not understand the distinction between, like, they go to the bank and perhaps they want to start out. They go to the bank, and who do they need to approach? The financial advisor, financial, what is the main difference between financial advisors? What is the main role that people need to do their research? Because we have to do our research. It's our due diligence to know, okay, when we go to the financial advisor, and they're not always 100% on point when it comes to us investing, making investments, right? So what is the main difference between a financial advisor and financial analyst? And, what is the main difference that comprises between all of them?
So I'm not a financial person. I'm a physician by profession. I'm a real estate investor. All I know is that I put my money when I was a resident to a financial advisor, okay? Financial analysts could be analyzing all the numbers that are provided to them by the company. Financial advisors, for example, I put my money into Northwestern Mutual Fund, Northwestern Company. So they have a person. That person may not even have a degree. They could take, a certification, an examination on the finances to be called financial advisor. So when they do that, they studied their Northwestern company, whatever they have in their business. They try to sell that to you because why? They're salespeople, so they need to know what they're selling. And a lot of times, my financial advisor was telling me, hey, put your money into this stocks, put this money into bonds. So basically, he was playing my money. I was giving it to him and he was putting it wherever he feels like it, right? So I took my money. I told him, no, thank you. From now on, I will be deploying my money on my own. I will study, because who is the most capable person of taking care of your money? It is me, not my financial advisor. He has an ulterior motive of being paid. Whether my money makes money or not, he gets paid. So if I'm losing money, I still pay him.
That is true, because so it comes down to doing our due diligence. At the end of the day, friends, you have to do your due diligence. No matter, when you're in the marketplace, you're looking forward to making investments, you have to 100% do your due diligence. Don't rely on real estate agents. Don't rely on people to tell you, oh, this is a good home, this is a good investment. You have to also be thorough. You have to do your due diligence. And in this way, it will educate you. And the more educated you are on a particular investment, then you are, you're the one that's going to be in control.
The question
So,
really is, where do people get our advice? Before, when I started, when my financial IQ was low, I
well,
was
that's a good
giving it to
point.
somebody
Exactly.
else.
That's right. Yes.
I was handing it over to my financial advisor because why? I was like, okay, let me do what other people are doing. And majority of my attending physicians were doing investing their money into stocks. So then they introduced us to these financial advisors. They invited, Northwestern, which is the company that they invited. And so I put my money, I was dollar cost averaging. And then after I learned, I increased my financial IQ. Hey, there's more to it than just giving my money freely to the financial advisor. So where are you getting you have to
Yeah.
qualify where you're getting your advices, right? Do they have business? Is their business making millions or billions of money? So my question to you is, where are you getting your financial advice? If you are getting it from somebody else that makes less money than you, take it back. Don't even deploy that money. Make sure that you give it to somebody who's making more money than you do.
Now, you know what? On that same point, before we do wrap up, on that same point, if you're searching for, an investment, for example, okay, you want to make an investment on this property, or you want to, make X amount of money. Now, you might be asking your friends or your family, but if your friends and your family, they haven't made those investments, or they may be broke, right? They've lost their job, they're broke, say for example, hypothetically, then why would you ask them for any advice, any opinion? Because they're not going to give you the right opinion, because they've not been successful, perhaps, right? Or they've just lost their job. So do you think they're in any shape or form to give you the correct advice on how to make money? Because then they're broke. So a broke person, I don't want to disregard anyone, but this is the fact. A broke person, how are they even capable of giving you any monetary advice? So, as Ria mentioned, you got to be who is giving you advice and follow that path. Follow those people who have been successful, who've made the money, and who know how. Okay, that's the most important. They know how to. Because once you know how to, and you've lost all your money, say for example, you absolutely know how to make the money back, because you've done it. You've come back. For example, Donald Trump. Okay, he's a perfect example that I at least follow, and I think most people follow him. As to he's has a very good business acumen, and he's lost money, but he's also proven he's built the money. He knows how to make money. So Ria, that is just, I mean, yeah, great advice. It really is. Who is giving you advice?
That is true.
Mm-hmm. And so, friends, okay, so we've come to the end of the show, but you know what? As I always say, knowledge is power. Okay, you've got the knowledge. You come here every single time, and we certainly appreciate you doing that, because you could be anywhere, you could be at your job, but you're tuning in, you're listening, you're gathering information as to how you can better improve your life. So, knowledge without the implementation is, well, it's just knowledge, but we want you to go and apply what you learn. So every single time, go and implement what you are learning, what you've been taught. And Ria and I, we always want to give you value. The more value that we give to you, the better you are. So that we absolutely know that. And so go and implement on what you've learned.